Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. I am here today to talk a little bit about creative financing. So in the world that we're in today, the mortgage rate market that we're seeing with higher mortgage rates on conventional and government-backed lending, we're seeing a lot more people dive into creative financing. So I want to talk today about a handful of different strategies that fall within the creative financing options and how they work and how investors especially are using these creative financing options to acquire more real estate during a time where leverage isn't quite as powerful as maybe it once was. So that's our topic for today. Let's get right into it. I think one of the most prominent and most used creative financing options is seller or owner financing, right? So seller owner financing is where the person who is actually selling the property acts as the lender, and they're going to either finance part or all of the purchase price. Generally speaking, they're looking for some type of down payment. They're looking for some type of contribution so that you've got skin in the game. But essentially, they are, you're going to run the real estate transaction just like normal. You'll kind of negotiate your terms with the seller on the property, but you'll also negotiate the terms of the lending. So in a traditional financing situation where you're working with a lender, there's not really a negotiation of rate. It's just what the going market rate is for that particular loan. In this case, you can negotiate whatever works for the seller. So if the seller is willing to give you a 3% interest rate, that's fantastic. So what you'll do is you'll create a deed of trust on the property, essentially like a mortgage on the property. You could do a promissory note. There's a couple different ways that you can do it, but what it ultimately does is it essentially makes the seller the person who's creating the mortgage, and they can foreclose on the property in the event that you don't make your payments. So they'll generally require some type of down payment, maybe a 10% down payment, and then they'll finance the rest. And the great thing about this is you can, again, you can kind of create your own terms on the financing. So you may, for example, say, can I do interest only, right? So I'll take out a $500,000 loan. I'll pay 5% interest only. So 5% interest only loan would be $25,000 per year in interest and in total payments, which is going to equate to just under $2,100 per month in a payment. So while you won't be paying off any principal, it gives you the opportunity to acquire a piece of property or leverage a piece of property at $500,000 and only have a monthly payment of $2,100 per month plus, taxes and insurance and things like that. But what it does is it creates the opportunity to potentially cash flow a deal that may not have cash flowed before. Right now, a $500,000 loan, principal and interest at 7.5%, where maybe conventional financing lands right now, is going to put your payment significantly higher. Somewhere in the high 2s to low 3s. So the reality here is if we can save some monthly money as an investor, we can purchase a property, only pay interest, and then when we get to a point where we're in a better rate market, it gives us the opportunity to refinance into a rate term kind of 30-year principal and interest loan where we can start doing that, but we want to do that in a better rate market. So seller financing or owner financing can be really powerful. On the flip side, as far as a seller is concerned and whether or not a seller should be doing this, it really comes down to opportunity cost. And so there also can be some tax benefits to it as well. So if you're going to seller finance, the opportunity cost is if you let's say you owned a property outright for $500,000 and you were offering owner financing for $400,000 of it, you were requiring $100,000 or 20% down payment. The opportunity cost is what could you do if you sold the house outright? You would have all $500,000 instead of just $100,000. Because right now, if they buy it from you, they're going to bring you $100,000 and you're going to finance $400,000 of it. So you're essentially leaving $400,000 of equity in the property. And if you're charging 5% interest, that's going to be your ROI on that particular investment, 5% on 400,000. So the opportunity cost is what could you be doing with that money instead? So if you took that whole chunk of 500,000 and invested it in a stock market or something like that, maybe you make 8%. So your opportunity cost would be 3%. In this case, what happens is it allows the seller to leave their money in real estate and have the power of a foreclosure in the event that you default on the loan, and they get to keep the original $100,000 down payment. So there's some value there. The second piece is there's some value with sellers in holding the property or not taking the entirety of the funds in a single calendar year. So there's some tax advantages in the event that you don't receive all the funds from that property sale. There's some value in keeping some of that money in the property in a loan and getting that paid off, over time or down the road. So anyway, seller financing is very popular. A second one that you may hear of is what's called subject to transactions. And I can't remember if we've talked about this before in a prior podcast, but subject to transactions, there's a couple of YouTubers. Pace Morby talks a lot about subject to. He's kind of this guy really knows his stuff. So if you look up Pace Morby on YouTube and look at his videos, he can really explain and goes really deep into a subject to transaction. But essentially, the overarching goal of a subject to financing deal is that you're going to take over the existing payments from the seller. So the seller already has a mortgage on the property, and let's say that mortgage is at 3%. The reality is that you're going to make the payments on behalf of that seller. But the mortgage is going to remain in the seller's name, right? And so the property you own, they're going to sell the property to you. So the title is going to go into your name, but the mortgage is going to stay in the other person's name. Now, there's some mixed feelings about this process because the reality is that mortgage companies don't want you transferring the title of your property and leaving your name on the loan. It's not secure for them. So there are people that say, well, per their terms, they can call the mortgage and make you pay it off in full at any time. And then there's other people that have the mentality that's like, mortgage companies just care that they're getting paid. So as long as they're making their money, it's not going to be a problem. I kind of fall somewhere in between those two personally, where it's like, well, yeah, I agree that mortgage companies are looking to just get paid and really don't have a whole lot of an issue if they're receiving their money each month. But when they're receiving their money on a 3% loan and they know they could push you maybe into a 7% loan, forcing you to refinance, there is a possibility there where it seems more actually attractive to say, no, you can't do this. So again, as a buyer, you're going to go in, make the payments to the mortgage company, to the seller, and the title is going to go into your name. And so what you're ending up doing with something like this is the value of a subject to transaction isn't the purchase of the property. You're essentially purchasing the leverage. So if you can purchase the leverage at 3% versus putting a new loan out at 7%, it's extremely valuable. So what you'll actually see is where this happens a lot, subject to properties where this happens a lot is where you see a property that's been sitting on the market for a really long time at a certain price point. And maybe that price point doesn't make sense at a 7% mortgage rate. But at a 3% mortgage rate, that price point makes a lot of sense. And so what you do is you can go in and say, hey, I'll give you purchase price. I'll give you list price for the property. In fact, maybe I'll give you even more than list price for the property, but I want to be subject to. I want to keep your loan on it. Okay. So there's also some thoughts about, if the seller keeps that loan and they want to move into another house, well, now is that debt going to hurt them when they go to buy another place? That's certainly a great thought. There are some steps that you can go that say, if you can show that you personally have not been making those mortgage payments for the last 12 months or something like that. There's potentially some ways around it. But anyway, this is something to consult a professional about if you're going to do a subject to. So similarly, and we haven't seen this much since, it's been a few decades since we've really seen anything like this. But, if rates continue to get worse, which we really don't foresee, we've talked about, why we believe rates will come back to earth a little bit in 2024 and 2025, but wraparound mortgages are something that haven't really been around for a couple of decades. But in this particular strategy, essentially what you're doing is that you assume the seller's existing mortgage, and then you create a new larger mortgage that like wraps around or encompasses the original one. And then you make payments on the new mortgage and then pass the payments on to the original mortgage to the seller. Okay, so it's kind of a complicated thing, but basically what happens is you end up making a spread between the two mortgages. So again, the reason you would do a wraparound mortgage is if you had a really low rate on that first mortgage, right? So those are a couple of the initial strategies. Outside of that, we have a lot of different options, from private money to hard money, partnerships, joint ventures, things like that. So let's talk a little bit on those. The hard money is something that's obviously been around for a long time. Hard money lenders are basically they're short-term loans. So generally speaking, they're 12 months or less. Sometimes they might extend a little bit past that. The way a hard money lender works is generally those loans are going to be based on the property value or the ARV or after repair value of the property versus your actual qualifying power and your credit score and things like that. So they're really not qualifying you as much as they're qualifying the property. These hard money lenders generally have some type of interest in real estate, and so they're okay. If you default on your loan, they'll just foreclose and take the property, and they're okay with that because as long as you have skin in the game, they're moving into some type of equity. The second piece of that is hard money loans are very expensive. So generally speaking, depending on the rate market, you might be somewhere between 10 and 16% interest. And then also there's generally, a points payment up front. So when people are talking about hard money, you may hear people say something like 12 and 2 or 10 and 2 or 14 and 1. What that means is the first number is your annual percentage, and then your second number is your upfront points. So let's say you're borrowing $300,000 at 10 and 2, you would pay 10% interest only on the $300,000. Okay, so you pay $30,000 per year, $2,500 per month. Okay, and then the 2 points up front is 2% of the loan. So you're going to pay $6,000 up front to borrow the money, and then you're going to pay $2,500 per month. Now, some hard money lenders will say it's 2 points, and we'll do 1 point at the beginning and 1 point at the end. There's all kinds of things. Again, this is something that you can negotiate because it's private money. And there's no government guidelines on these types of things. It's just going to somebody who's got a lot of cash, willing to loan their money out and looking for a great return. Okay, very similar to hard money lenders or private money lenders. These are similar in that they don't conform to the guidelines of like government-backed loans. but a lot of times these are longer term loans. So you might get a 5-year, or a lot of times what'll happen is they will do a 20 or a 25 or a 30-year amortization of the loan, but they'll do like a 5-year balloon payment or a 10-year balloon payment. Like, so you're going to only have the loan for 5 years, but they'll make the payments look like it's 30. And then after 5 years, you're going to have to refinance out or pay the loan off in full. Okay. So private money lenders just don't conform to the essentially just don't conform to the traditional lenders, and then you're going to have a little bit more flexibility when it comes to the terms of the loan. So another option is to do partnerships or joint ventures, and basically what happens is you're partnering with another person or another individual or even an entity that has capital. But a lot of times they lack kind of expertise, or sometimes, most of the time, they lack time to invest in real estate. And so what happens is, in this case, you're not paying back necessarily a loan. You could be doing this as well, but you're not necessarily paying back a loan. In this case, you're going to share some responsibilities, but you're also going to share profits. So it's similar to an equity share, a partnership or a joint venture. But a lot of times there still might be a level of interest that's paid on a loan that comes into that from that person. So they may say, "Hey, I'm going to give you a loan. I'll do it at 5%. But I want a 20% equity chop at the end of the transaction." So when we talked about, we've had prior episodes talking about syndication. Syndications are generally kind of like a joint. Well, they could be a joint venture, but generally they're like LLCs with limited partners and general partners. And so there's a couple of different ways that you can go about it. But individual partnerships, or if you have maybe 2 people or 3 people, those are good as partnerships generally. So, the equity sharing again is a partner or an investor who provides the funds for the down payment or the rehab or whatever, and then you're just sharing equity in the profits from the property. So this may be something where a person goes in, one person contributes all the money, and the other person does all the work, contributes basically the sweat equity, does all the rehabilitation, takes care of everything. That may be an equity share type of a partnership. And in that case, sometimes you won't necessarily have like interest paid on the money. Right. So there won't be a loan necessarily. It'll just be like, "Hey, I'm going to get my money back, and then we're going to take an equity share at the end, whatever percent that may be." So outside of that, we have some of your own personal ability to pull lending that isn't a traditional conventional, again, government-backed loan. And in this case, it might be something like a home equity line of credit, right? So we've talked about home equity lines of credit or HELOCs before. You've got a property already, you own you have a significant amount of equity in it, and you use a home equity line of credit to access funds for that down payment or for the renovation of another property. Home equity lines of credit are extremely powerful in that they're essentially like a really big credit card with a really high limit and a much lower interest rate. So for people that are walking around with tons of credit card debt, but they've got lots of equity in their home, really what you should be doing is you should be doing a home equity line of credit and then consolidating that credit card debt. Most credit card debt is somewhere in the neighborhood of 20 to 30% interest, where a home equity line of credit right now might run somewhere between 9 and 10%. So if you can trade your 20 and 30% debt for 10% debt, obviously that's extremely, extremely valuable. So a home equity line of credit, you can use a home equity line of credit for anything. Now, when you go apply for it, they're going to generally ask you what you plan to use it for, and you can say, "Hey, we're looking to do some home renovations, maybe purchase an investment property, something like that." One thing you don't want to do is go, "Oh, we're going to use it to buy a second home, and then or buy our next home, and then we're going to sell our home." They're not going to put a loan on a property that maybe you're only going to have for a couple of months. They're just not going to go through that process. So anyway, you can get that home equity line of credit out. And then it just becomes a really big a really big credit card because it is a revolving line of credit, which is really nice. So if you put, $10,000 on it, or let's say you pull a line of credit for $250,000 and you go out and you buy a property that you're going to flip, you put $100,000 down and you do $50,000 in rehab, and you have $150,000 balance on that HELOC. When you sell that property for a profit, you can pay off that $150,000, and now you have that $250,000 line of credit available to you again. So just like a credit card, when you pay it off, you have that line of credit available. So they're extremely powerful, and they generally have very favorable terms in that you can generally borrow off of them somewhere between 10 and 15 years. And then the payoff period is generally somewhere between 15 and 20 years after that. So you could borrow on it for 10. At 10 years, whatever balance is on that line of credit, let's say it's $100,000, they're going to lock that balance in, and then they'll amortize it over the next 15 to 20 years. So it gives some really great opportunity to borrow your own equity and put it to work. Again, you might be paying 9% on it, but if you can take that money and make 15, 20, 25, 30% by making some great real estate investments, there's some great opportunities there. So home equity line of credit is a great way to do it. Second mortgage. If you want to take out a second mortgage on the property, those don't tend to be as popular. But a seller secondary financing is possible as well. So if you go buy a property, you can do traditional financing, and then for the remainder, you could do seller financing. That gets a little bit tricky to get qualified for your first loan when you do something like that. And the seller has to be okay with being in what we call second position, which means if you default on the property, the main mortgage company is going to get their money first, and then whoever's second in line is going to get their money second. So outside of that, there's a couple other, I guess, smaller ways to generate money to purchase real estate. One of them is like a peer-to-peer lending platform. I think there's a couple out there. I think one's called like Lending Club, and I think there's one called Prosper. But they allow you to borrow money from individual investors, and then the thing is the loans are generally like they're personal loans and they're unsecured. So, a mortgage is a secured piece of debt. It's secured by a piece of property. These are unsecured personal loans. So the interest rates are generally going to be pretty high. They're going to be pretty crazy. So, and these loans, a lot of times they're kind of crowdfunded, right? So similar to which I guess is kind of maybe my last piece, similar to like a real estate investment trust or a REIT, which is something that you can buy just on the stock market. You can go to your local trading platform and you can purchase these REITs. And essentially what it is, it's real estate crowdfunding platforms that you pool funds with other investors to do real estate projects. So REITs will go out and build a fund of millions and millions of dollars, and then they'll go out and they'll diversify that money into a bunch of different real estate. They could do commercial, they could do big multifamily, single family residential, that type of stuff. So you have companies like BlackRock, for example. BlackRock's a huge real estate investment company, but the idea is if you don't have $100,000 to go out and buy a property, but you get $500, you can go buy a real estate investment trust and enjoy some of the returns. And the generally REITs are not super volatile in their valuation of the actual stock, but they tend to offer like really nice dividend returns. So it's not uncommon to see REITs out there that offer 6, 8, 10, 12% dividend returns. So anyway, that's just I think a quick overview, of maybe 10 or 12 different options for creative financing. And honestly, anything that someone is willing to do can be done, right? Like we call that creative negotiation. It's negotiating essentially favorable terms with sellers or lenders or private money people. You can do all kinds of different things. You can do deferred payments. You can do extended closing periods. So like, you're going to buy the house, but you don't want to buy it for 6 months because you won't have your funds. Sellers may do that for the right price. Deferred payments, like, hey, I'm going to buy the house from you, but I don't want to make payments for 3 months, or I don't want to make payments for 6 months. There's all kinds of different things you can do. Like I said, interest-only loans are very favorable upfront. So anyway, pretty much anything you can think of and that could be put into a legally binding contract that two people are willing to sign can be done. So people are always coming up with new opportunities for creative financing. And I think the biggest thing to understand, to kind of wrap up our episode today, the biggest thing to understand is that when you are considering creative financing strategies, you need to thoroughly understand the risks and the terms and legal implications of every option that you have, right? So if you're doing something like this, you should be working with, first of all, a real estate professional, probably an attorney, maybe a financial advisor, because you really need to be making informed decisions, and you should be complying with your local laws and regulations. So I think, each strategy differs, and it depends on what you're looking to do. Some make more sense than others. So for example, like hard money lending is great for flipping homes, because they're willing to do short term. They're willing to give you money for 3 months, 4 months, 5 months. The other stuff, sellers may not be willing to do a seller finance for 3 months. It doesn't make a whole lot of sense for them. So when sellers do seller financing, for example, they're usually looking for some type of stability over a period of time. So it may be 3 years, 5 years, something like that. They're looking for a little bit of stability and some consistent income, right? And so hard money investors are looking to get their money out, make as much interest as they can, and get it back as quick as they can, and kind of recapture that capital every time. And so anyway, my disclaimer, in addition to my pre-written disclaimer on this podcast, is make sure that you're consulting an attorney. If you're doing promissory notes, if you're doing seller financing or hard money, make sure you consult with an attorney, and make sure that your contracts are legally binding and on the up and up, and everybody understands what they're signing. So I think that is it for today's episode. I hope this was informational, and that you guys learned a little bit about traditional financing. There's great information on all of this stuff online. So you can go look up any of these strategies, and there's a ton of there's a wealth of information out there, a ton of people that talk about each of these in much more depth, I suppose. So anyway, if you're looking to learn a little bit more, would love the opportunity to talk with you. I'm happy to have a conversation with you about some of these options. And if you're looking to be one of these people that does seller financing, hard money financing, that type of stuff, please reach out. I can hook you up with the right people, and people that are looking for money to do projects all the time. So take your money, do something cool with it, buy some real estate, loan it out to somebody that's buying some real estate, and remember, live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.